On Saturday, May 7th, the Terra blockchain started a rapid descent that ended up costing $30 billion and killing the blockchain. The Terra blockchain is made up of two tokens, Luna and UST, and was one of the most popular blockchains, peaking as a top 10 coin in market cap before its untimely demise. The reason for its implosion was that its stablecoin, UST, which is supposed to be pegged and valued at $1 USD, is now only worth 2 cents. This rapid descent is known as a death spiral. Terra Labs tried to save the system by pouring billions of dollars into the system to prop up its failing currency, but in the end, there is a vote to create a hard fork to a new blockchain where they will try to rebuild from the ground up. So, to understand why this extreme crash was even possible, we first have to look at how Terra works. The Terra ecosystem has two main tokens, Luna and Terra USD, known as UST. The Luna and UST tokens work together to create an algorithmic stablecoin. Breaking this down, a stablecoin is a coin whose price is supposed to maintain a value at $1 USD. Most stablecoins are currently collateralized by physical assets. Tether, for example, came under intense scrutiny by the U.S. Financial Regulations Committee and have since shown their collateral and gave a breakdown of their backing, mostly in cash and loans. Terra, on the other hand, aims to be completely uncollateralized. This leads to multiple pros and cons. The major pro of Terra having a completely unbacked stablecoin is that they can grow as quickly as they want. Other stablecoins would have to raise capital to then mint more coins, but Terra is not limited and can grow as quickly as people put their other digital currencies into the ecosystem. For example, while DAI, another stablecoin, has stagnated in growth, UST has doubled to triple the amount of stablecoins in the system over the last year. The major use of the Terra system is to be used as a payment system, and so having more stablecoins helps adoption of the system greatly. So how is the new UST created if it doesn't have to wait for external funding? The core thesis of Terra is that one UST will always be able to be exchanged for $1 of Luna tokens. In this manner, whenever you want to convert from one coin to another, you will burn one UST, meaning it's destroyed from the ecosystem, and you will receive $1 of Luna by minting it, creating new tokens of Luna, or vice versa. In this manner, Terra uses the Luna token to regulate the price of UST so that it remains pegged to $1. If for whatever reason UST is trading above $1, people could buy $1 of Luna, burn their Luna for 1 UST, and because 1 UST is now worth more than $1, you can sell it and make profit. Likewise, if UST is below $1, someone could buy 1 UST, burn that 1 UST, and then receive $1 of Luna in new tokens, and then sell those tokens for a profit. This process is known as arbitrage. While this method is extremely smart and is used in many other automated market makers such as Uniswap, in this specific use, the demand for Luna controls the entire ecosystem, and so there are no underlying reserves such as the other stablecoins which have physical assets. This means that for whatever reason, if people lost faith in Luna, UST would be worthless and vice versa. So the major con of Terra, having a completely unbacked stablecoin, is that with no physical backing, they are completely reliant on people looking for arbitrage opportunities to regulate their entire system. Unlike in other stablecoins, where there's always the underlying value of cash that they held off-chain, there is nothing backing the coin. This system is a huge risk-reward opportunity because this allows the system to grow exponentially while being inherently more risky than other stablecoins. Looking back at Terra knowing it's failed, it was very obvious from the start that from the mechanics, Terra is very different from many of the other cryptocurrencies. But that doesn't mean that everything that they chose to do was wrong or even bad. And some of these design choices actually gave Terra competitive advantages over other cryptocurrencies. The first was Terra's staking policy. Terra's staking policy was dynamic based on the price of Luna. If we look at other cryptocurrencies such as Ethereum, it has a fixed 4% APR no matter the price of Ethereum. Luna, on the other hand, had a dynamic system. The equation is for every 1 Luna coin, you would receive 1 UST plus 0.05 Luna on an annual basis with a 21-day minimum staking period. In this method, As the Luna coin increased in price, the staking rewards would lower, but at very low prices, the percentages were very high, allowing for buy pressures at lower prices. This gave people incentive to buy at lower prices while still having fair returns at higher prices. Another benefit of the Terra blockchain was the Anchor protocol. The Anchor protocol was the primary way to make passive income in the Terra ecosystem using UST. Acting as a pseudo bank, users would deposit their UST and allow other users to borrow UST using other cryptocurrencies as collateral, mainly Luna, Ethereum, and Avalanche. The importance of the collateral choice was that Anchor only allowed borrowers to deposit coins which could be staked, and then would take the staking rewards, sell them for UST, and pay the depositors with that UST. In this way, they turned the coins from trapped collateral to interest-bearing collateral, so long as the staking rewards were non-zero. Thus, Anchor staked the collateral to earn yield and charged its users for the loans, and so the returns were from both staking and the interest from loans, and the depositors would receive higher interest rates than other systems. At a core idea, this system was extremely reliable and would look to be a good source of income in its current state and a great addition to the ecosystem. Algorithmic stablecoins have come and multiple have failed due to very similar death spirals. While those coins failed, UST has actually thrived and made it to the spotlight for much longer, though it has had some close calls in the past. In May 2021, as the entire market was crashing, UST became unstable and traded in the 85 to 95 cent range, but was able to recover at this time. The real issue was while all of these are great projects, Terra focused a lot of its energy on the Anchor protocol and tried to funnel money and interest into UST. But why? Because, in the process of creating more UST, more Luna is burned, increasing the value of Luna as supply decreases, quadrupling the price over the course of a year. So by trying to incentivize more people to buy UST, it would increase the price of Luna, which would draw more interest into the ecosystem. They accomplish grabbing people into the ecosystem by creating a fund to give people even higher rewards than Anchor was offering, pushing people to join the ecosystem. At the height, rewards of 20% were being offered, which was insanely high compared to other giants in the space such as Ethereum offering 4%. They were able to maintain those rates at first, as borrowing rates were high, and Terraform Labs gave them that subsidy of 100 million UST to cover any difference. This insane interest rate resulted in $14 billion of UST out of a total of $18.7 billion of UST being staked solely on the Anchor protocol. This would not have been an issue except the amount of people borrowing did not increase at the same exponential rate. This meant that Terra would have to subsidize up to $1 billion per year in staking, which was not sustainable. And so, something had to be done. The result was that the governance of Anchor voted to decrease the yield over time. This decrease of yield was the beginning of the end for Terra. Now that yield has decreased, people started to leave Terra to go after other ventures. The two ways that you could get out of the Terra ecosystem is to either burn UST and mint new Luna and sell those assets, or exchange UST on a liquidity pool such as Curve. In these liquidity pools, they hold multiple stablecoins that can be exchanged with each other. By design, UST is usually around 25% of the pool, but now, due to intense sell pressure, skyrocketed to 50% as people were trying to dump all of their UST. Now, from supply and demand curves, the supply increased to a point where UST is now worth less than $1 as so many people were trying to dump UST at any price that they could to recover some of their losses. At a certain point, someone even traded 85 million UST for 84.5 million USDC, essentially taking a loss of $500,000 on two assets that are supposed to be the same price. On the flip side, as demand for UST essentially dropped to zero, people started to burn UST and mint new Luna to try to recover their funds that way. Both of these factors cause intense pressure on the UST to depeg as so many people were trying to leave the ecosystem with no buying pressure from the other direction. As a huge influx of Luna occurred, Now, the price started to crash because of the excess coins. Basically, the only reason people were interested in Terra at all was for the incredibly high interest rates on the Anchor protocol. And as the ecosystem made the best decision to stop bleeding $1 billion per year, it caused a crash as everyone wanted to get out, initiating a death spiral. A death spiral has been seen in many different areas before, especially in the stock market. Basically, a death spiral is a maneuver which occurs as an asset has a convertible bond. In this case, we have Luna as the asset and UST as the convertible bond, as UST is exchanged for a variable rate of Luna. As Luna price starts to decrease due to market factors or people losing faith in UST, the price of Luna starts to decrease. As more people want to get out, more people will mint Luna. And as the number of these coins increase, the price of each one will decrease significantly. By diluting the price of the asset, even less faith is placed in UST, so there is now even more selling pressure, decreasing the price of Luna even further. This is exactly what was seen. As UST became unpegged, people wanted to redeem it for Luna to get their money out. The final numbers were that there were 343 million Luna tokens on May 8th. On May 12th, that number reached 32.3 billion, and when the dust settled on May 28th, the number ballooned to 7 trillion coins. But how could the Terra organization allow this to happen to their blockchain? Well, there are a few ways to stop a death spiral that were implemented. The main way to stop the death spiral is to restore confidence in UST and repeg UST to $1. The first method they tried was to restore the curve liquidity pool to balance by dumping $216 million worth of non-UST stablecoins into the pool to restore the previous balance of UST to non-UST stablecoins. However, while there was a brief recovery to 93 cents, there was simply not enough interest on the other end. So, as the excess liquidity was burned through, the USD price continued to fall as, again, no one was interested in Terra without the Anchor protocol. Another method was to pump Bitcoin into the system and use it as a buffer for the death spiral to slow. As UST would be redeemed for Bitcoin instead of Luna, this would result in less minting of Luna, and the spiral would temper itself as it burns through these extra reserves as UST is able to come back down to a reasonable price. It was reported that $1.5 billion was added into the system, but it simply wasn't enough to stabilize the entire system. At this point, Terra could have allowed the arbitrage system to continue and hope that UST can repeg. The downside of this is that to repeg, the price of Luna would suffer immensely, as people would pick up UST for lower than $1 and mint new Luna that would then be sold. And even worse, if the UST became too unstable and went to $0, so would Luna. Or they could have completely abandoned UST entirely and started a new stablecoin, saving the current price of Luna, but straining everyone who had UST. In the end, they tried to allow the arbitrage system to work. While trying a few last-ditch efforts such as burning UST without minting Luna, it failed. When the word spread that UST became unpegged and looked unstable, many tried to sell their Luna as there would soon be an influx of tokens making their investments worthless. Terra actually has a protocol that limits the amount of arbitrage to $150 million per day, capping how much UST could be converted in a single day, and capping the amount of transactions. However, those on exchanges such as Coinbase or Binance had no such cap, which allowed Luna to tank even lower, giving no chance for UST to repeg as its other half crash. This is because exchanges allow users to trade their tokens without having to interact with the blockchain, as all the funds are held in one central place, and exchanges give users dummy tokens to trade with. To learn more about this, check out our other video about wallets. In the end, the final numbers illustrated the true effect. Like mentioned before, the amount of Luna tokens increased by over 20,000 over the course of 2 weeks, rendering the coin worthless. The Anchor protocol, which used to hold $14 billion of UST, now only held $2.14 billion in deposits and only $150 million borrowed as of May 12th, showing the disparity between the deposits and the borrowed. This meltdown cost $30 billion and destroyed a top 10 cryptocurrency. There are a few main takeaways that we can learn from this extreme meltdown. The first is that, as of now, collateralized stablecoins are needed to protect people's money as well as ensure that entire blockchains don't self-destruct. While this severely limits growth, it has been shown that algorithmic stablecoins are nowhere near stable enough at the current moment. Following that, the second takeaway is the instability of algorithmic coins. Users correctly illuminated potential failure modes such as a death spiral and the exact mechanics that would result in the crash of Luna, but were convinced the value of the blockchain would carry it forward. There are also rumors that while there are some instability at first, that could have been recovered. Enemies of the blockchain executed an attack where they dumped $400 million worth of UST that caused the initial panic and the run on the bank. But so far, no one has claimed credit. No matter whether the rumors are true or not, it is a fact that Terra was far too reliant on enticing people into the system with extremely high interest rates on Anchor. As soon as that became untenable and the interest rates were reduced, there was simply no value in the ecosystem that warranted the price and volume that we're seeing currently. This issue isn't solely for Terra though. Many cryptocurrencies have limited to no use cases, and a lot of the value is driven off the potential use of high returns. But algorithmic coins are extremely sensitive to these issues, as their falls are extremely fast and volatile as nothing is backing them. Lastly, news recently dropped that the founders of Terra have decided it is time to move on to Terra 2.0. They plan to completely abandon Terra, rename it Terra Classic, and create Terra, that does not have an algorithmic stablecoin, known as Terra 2.0. After completely destroying an entire ecosystem, they are trying to move on to another chain and start again, giving owners of Luna at the time of the crash tokens in the new chain. There is not a lot of trust, and without a stablecoin to pair, Terra loses a lot of its use cases, limited as they were. Overall, Terra was an interesting case study into algorithmic stablecoins and their drawbacks. In the end, it is clear to see that if this crash did not occur now, there is not much hope for the future. Anchor was backed into a corner and would be bleeding money over the course of the next few years, and was simply crippled by unsustainable interest rates. Now we have seen Terra 2.0 launch, and we have seen it has not garnered the same interest as the first iteration. It has also come to light that the creator of the Terra ecosystem seems to engage in predatory business practices, and goes to show that crypto is an extremely volatile space, and even the top 10 coins are not immune to large issues. Hopefully through this video, you now understand why Terra failed and why the mechanics were always destined to run into issues. While algorithmic coins are extremely powerful, the risk is extreme, and for now, there do not seem to be any solutions.